Welcome.
Good evening, everybody. I guess you can hear.
Okay, for the recording. So good evening, everyone. Very nice to meet all of you. So I understand today is only physical. There is nobody online. It's only offline. But we still record because we may do some replay. That's why. Please note that there may be some replay in the future. So tonight is what we call the M&A committee. So we created it used to be the M&A club a few years ago before COVID, and so many things have happened since then. So we thought it was a good timing to reinitiate and update all of you on what we see on the M&A trends happening in China. So you will see there is a few slides introducing ourselves. So we introduce both of us, who we are, what we do, and then we will introduce these trends, and there will be some Q&A sessions at the end of the show. So without further ado, you want to say a word, Bruno?
Good evening, everybody. I'm very happy to be with you tonight. Let's start the presentation.
So very quickly, who we are, because I think it's good for you to know who will be presenting to you tonight. So I work for an investment bank called CFI. So for those of you who knew me, I'm the founder of a French boutique investment bank called BNA, Benoît Associés, which was acquired this summer by CFI. So we are now CFI BNA. So CFI BNA is an investment bank group. We are present in 19 countries. We have close to 300 investment bankers around the world, and we do between 100 to 200 deals per year. And this is the services buy side, sell side, capital raise, valuation, and so on. We can go to the next slide. Yeah, it's me who control. Easier talking to myself. So we have 16 sectors. You can see from automotive to logistics through machinery, industrial. So I would say we cover all the sectors, and we are organized by specialists in each of the 19 countries. So very, very sector oriented. So this is some of the recent deals, China angles. So just for you to understand also what we do and the evolution. I don't know, is there a laser? There's a laser here. Is this one? Is this one? This one? So yeah, so that's the China angle. So, and you will see that in the trends that we have seen, like for example, 2018, where you had the big waves of Chinese outbound deals. So we saw Groupe Zanier. So for those who know, it's like 15 kids fashion brands, Catimini, Absorba, which we sold to the largest Chinese kids fashion group, which is called Semir, which is the brand's called Balabala. So that was at that time, you had the big waves of outbound deals. And then what we start to see is some French groups leaving China. So for example, Engie. So Engie who left China. So we saw one of the activity in Chongqing to Singapore Power, which is a state-owned Singapore group owned by Temasek. And what we also saw, and you will see in our next slides, is an acceleration of foreign groups buying Chinese companies. And for example, Bell Group, which is the leading cheese manufacturer worldwide, who invested into Laoji Mofang, which is a healthy snacking company in Hangzhou. And recently, we saw Pierre et Vacances activity in China, the sale and lease back. We did a deal in the US, and this summer, we sold FM Logistique to another, you probably know Seva, which is CMA CGM Group, which is the third largest shipping company. So just for you to see some sell side, some buy side, and sell side of European companies based in China. So this a little bit summarized through these deals, the trends that you will see in the next slides. Bruno.
My name is Bruno Grangier. I've been in China for 20 years. I'm an entrepreneur. I'm also the founder, qualified lawyer in France. I'm a lawyer operating in China for, again, 20 years. Since 12 years, I created a law firm called Leaf. We are a team of around 20 persons in China and 5 persons in France. The idea is that we wanted to create a bicultural team, Chinese and European, in China. We are mostly advising. Tu peux faire tourner le slide si tu veux après. We are mostly advising. So at the beginning of the firm, it's pretty interesting. We were advising a lot of entrepreneurs, foreign entrepreneurs based in China, for the fundraising and the structuring of their companies. We sold a lot of foreigners, successful foreigners creating companies, and we sold these companies to either Chinese companies like Baozun, buying e-commerce platform or e-commerce advisory company to develop their business overseas. We sold also a lot of foreign funded companies to foreign groups who want to enter fast in China. We did a lot of transaction in the digital marketing industry, in the service industry. And nowadays, we are also advising a lot of large MNCs in Europe, investing in China. So now we start to actually represent buyers. We are representing buyers such as CAC 40 companies, large MNCs, who are penetrating the Chinese market, who are continuing their investment in China. And we will talk about these strategies a little bit later so that you can see what kind of deals foreign companies are doing in China and what we see. Emmanuel, you have prepared a slide on the trends of the M&A and the evolution.
Exactly. So before we talk about the trends in China, I think it's because China being very much interconnected with the rest of the world, we need to talk about what's happening in terms of M&A trends worldwide. So you have here, those are valuations of the deal. This is the worldwide M&A deals. And you see on the first 9 months of this year, we are 30% in terms of deal value compared to the first 9 months of 2022. So it's a big decrease, so we're aiming at reaching for the whole year less than 3,000. So it's 3,000 billion, which is 3 trillion. Thousands of billions are trillions. This is the metric. So you see, we are going to go back most probably at the end of 2023 to the year, when we were around 3 trillion, 2016, 2017. So it's not catastrophic. It's just like the base effect, because the historical year, 2021 was a historical year. We were close to 6 trillion, so 6,000 billion US dollar of deals, which are historical. The previous record was 2015. It was just 4,000 billions. So it was plus 50% higher than the previous year. So it was a crazy year. We know why, mainly supported by, abundance of liquidity, a lot of activity from PE funds, interest rates being historical lows, and so on. So this supported M&A trends, which reversed this year. And you can see, higher interest rate, geopolitical tension affecting, of course, the M&A. China slowdown, we'll talk about that. Economic outlook in Europe, which is poor, and some antitrust. So big deals. Now the regulator started to intervene in some big deals, blocking some big deals, including in the US, for instance, between the American companies, just to avoid, monopolies in a way. So all of this impacted or impacts today M&A trends worldwide. What is interesting to see is the cross-border. So this is close to a historical low. That means with all this tension, geopolitical tension, all these like various tougher antitrust environments, you see the percentage of cross-border. So those are deals between 2 different countries. It reached its lowest in the last 10 years. So you see that 27%. So much less cross-border deals. And finally, what we can say, so TMT leads the way and should continue to lead the way in terms of global deals, with everything, all the narrative we see today around the AI, around digital transformation, and so on. So this explained that. Energy was what happened around the barrel of oil, and then different services. What is also interesting here is the share of Asia. So this is the share of different regions in the global M&A. So you see Asia went from 20 to 25, so 1/5 to 1/4 of the deals, where you see US remained stable and Europe decreased slightly. So you see Asia represents a bigger share of what's happening in M&A worldwide. And within Asia, China represents around 40% of Asia. It is mainly, it's the main region, main country in Asia is actually China in terms of M&A. Now China. So here you see three, when we talk about M&A deals, there's three aspects to M&A deals in China. There is the outbound, so Chinese companies buying companies outside of China. Inbound deals, so this is what we mentioned earlier. So foreign companies acquiring in China, and then domestic deals. So you can see that most of the deals we're talking, so in terms of value, is between 400 and 300 billion of value. Those are in average, I would say, the value of deals in China. And you compare to outbound, you see the historical high of outbound was 2016, where we had a kind of exuberance. Remember 2016, Anbang, Wanda, Fosun, they were buying a hotel chain, they were buying football clubs, cinema chains, and most of it have been sold by these companies. Some of these companies went bankrupt or close to bankruptcy, like HNA, for example. And we see now a lot of those assets being sold, whether it's Fosun selling assets overseas, whether it's Wanda, and so on. So we see this year in terms of outbound is going to be a historic low. We have to go back to 15 years ago to find such a low. Is going to be around 20 billion compared to close to 200 billion in 2016. You see how much it went down in terms of value of deals. Inbound. So what is interesting in all these three aspects is the only growing area is actually inbound deals compared to the year before. So those are value on the first 9 months of this year. It increased by 30%. So the value of deals inbound is close to 40 billion. So it should reach around 50 billion for the whole year. It's going to be one of the top 3 years. You see the best year was 2018, but you see around 50 billion, which is higher, much higher than previous year. And the average for 9 months on this 6 years is around 34 billion. We are 38. So we are above the average 9-month average on the previous 6 years. So you can see that. And domestic, so it's crashing. It's minus 40%. So that's deals between Chinese companies. So in terms of value, 175. The other figure is number of deals. I will not spend too much time on number of deals. I will just focus on the value of deals. So minus 40%. It's mainly due to, of course, much less deal by private-owned enterprise. I mean, you all see what's happening in China in terms of private-owned enterprise. The regulator, has been intervening a lot on all the digital platforms. And I remember, before the COVID, 40% of the deals were made by 2 players, Alibaba and Tencent. So there was a lot of consolidation in the e-commerce digital platform, and they reach status close to monopolies. So this has been broken, and they were forced to divest. So much less deals from this platform, and also PE funds with the raise of interest rates, harder to finance deals. With the various geopolitics, much less funding available by PE fund in China. So this explains why, in terms of domestic M&A, it's been 40% less compared to last year on 9-month basis. So this is more or less explained here. On inbound, because this is what we're going to talk about, the reason why inbound is increasing is you have some of the reason why. So valuation at the lowest. So you can see here, it's like around 8 times. So for those of you who do M&A, one of the metric to value a deal is enterprise value divided by EBITDA. Some of you know that, some of you maybe don't know. So you can see that valuation of deals of inbound are being quite low. So people seize this opportunity. One of the reasons also is so low is in the past, you all remember before COVID, all the Chinese founders, they were dreaming about IPO, and therefore they have crazy valuation in mind. the IPO pipe has been almost frozen, much less deals, both number of deals and funds being raised through IPO. So also this puts pressure on valuation and pushes Chinese founders to be more open to foreign investors. So all this creates, I would say, a good momentum, a positive trend for foreign buyers to acquire in China.
Yeah, so let's repeat it. The M&A volume is actually a little bit growing up. And compared to the FDI, which is lower, means that the FDI is greenfield investment, companies investing and creating from scratch companies. It's also a bit hard also, I think that when we talk about outbound, it's really money coming out of mainland China to be invested, whereas we see that big players are Chinese-based, such as Tencent, Alibaba, they're already funded overseas. So they are not counted into this outbound M&A, which historically has been low and very controlled by the government.
So now if we focus, because, valuation, I mean, you all, for those who practice M&A, we all hear, wow, the Chinese seller, their expectation of valuation are crazy high and so on. So without going into detail, what we try to show is we looked at listed companies. Another metric when we value companies, we look at what their valuation as listed companies. So we looked at similar comparables. So we look at Western food companies, food conglomerates, compared to Chinese more on the dairy sector. And I think what is interesting is to see what the level of margin. So usually, and that's true in many areas. So you see margins. So this are EBITDA margin of foreign groups are actually much higher than margin of Chinese groups. So this usually is explained because, I mean, you all know that the Chinese, the most competitive market in the world, because you have all the foreign players on top of the Chinese competitor. And probably on the production cost, they have not done everything we have done in Europe in terms of being lean, efficiency, productive, and so on. So that explains that. But then if you look at the growth, so, for example, revenue growth. So revenue growth, CAGR, so it's around 6% for foreign companies. And you see it's like more than 3 times higher for Chinese companies. So then if you do something, so you look at the price earning ratio, for, something happened. Okay. And then, so price earning, people will tell you, Chinese, they are close to 30 times price earning. It's higher than foreign companies. It's too much. But then, if you look at another metric that traders look at is price earning to growth. So you divide the price earning on the growth, and you see that price earning to growth for a foreign company would be close to 4, and for a Chinese company, it's close to 1. Saying this differently, if you buy a company, for example, enterprise value divide by EBITDA, and if the EBITDA of the company doubled, the EBITDA of the Chinese company doubled every year, then the EV on EBITDA will be divided by 2 year over year. So looking at the price by itself doesn't mean much in absolute terms. What means in China is looking at the growth and also looking at everything you can bring as a foreign investor, as a foreign buyer, in terms of improvement of the EBITDA margin. Can you help Chinese company improving, maybe not reaching what you have in Europe, but improving the EBITDA margin? So then if you have the growth and you improve the EBITDA margin, then you are paying much less in terms of enterprise value divided by EBITDA. So this is something I know even sophisticated CAC 40 group in Paris, we need to explain to them, and local bosses sometimes have a hard time to pass the message to their board. Don't only look in absolute terms, look in a dynamic way. So I think it was interesting to show that. This is the common, we are staying on the inbound deal. So, the common hurdle. So valuation is here, but it's not the only hurdle, valuation, Usually it's like, how do you find the right company? Every groups we speak to, they want to find a company. It's not like in Europe. In Europe, everything is off the shelf. You have a, directory, or you Google and you have lists. It's not the case because the Chinese market is very, very dynamic. It's very fragmented. Everything is moving very fast. So what was true a few years ago is not true anymore. So that's why you know, you need some special tools. You need to get close to big data company, to people using AI. That's what we do in our case to find targets and to find the gold nugget. And then, you know, very often these Chinese companies, they look at market share. So they have big budget of marketing compared to sales. They don't care about profitability. Also, at times, they are developing non-core opportunities. You remember Evergrande going into electrical vehicle. Like, you know, so, you know, every time they see a nice opportunity, they jump on it. So trying to keep founders focus on the area and the business you like about them. So you can carve out the business you like for the target you have identified, for example. And then keeping momentum is very important because, you know, Chinese founders, they are solicited every day by like new opportunities, new idea, and so on. So, you know, keeping the momentum and making them like also focus is also important. And then, you know, I think for me, the key words, there's always, this is true everywhere in the world, you know, cultural, vision, strategic, some differences. But for me, trust is the key. We need as advisor, even though we work for the foreign party, we need to create trust with the Chinese target. He needs to trust you because usually Chinese target don't have advisors. So in a way, you become their advisors. So you need to have this relationship of trust, even though everybody is clear, transparent, you advise the buyer, but you still have to establish this trust relationship. And without trust, you cannot. And it's the same between buyer and seller, because most of the time, buyer would want the seller to stay as a shareholder. So you need to this trust within the shareholder agreement, for instance, because you will work together during a transition. So for me, trust is, for me, it's exacerbated in China compared to other parts of the world.
You're right.
Yeah.
And, I think keeping the momentum and dealing with this trust issue are essential in the course of the M&A deal. You were saying also something interesting. First, there's a lot of large targets or Chinese targets where the management is actually very flat. There's one decision maker and a lot of people around or below the CEO, and the CEO is only the only one taking decision. It's not the same way in MNCs or in foreign groups where there is a corporate governance organized, which also will create some disruption in the business of the CEO that will feel the process as a very painful process.
Yeah. Advisor allows people to remain taking care of the operations.
Yeah.
It to be less painful in a way.
Exactly.
So I'm not going to comment on this, but just to, you know, when people approach us and we know you have to take questions, like, what do I do? Do I do, you know, when I approach China? Do I do organic growth? Do I do a partnership? Do I do a joint venture? Do I do an acquisition? So I'm not going to go into details of all that, but if we look at the successful groups, whether they are French or European or foreign groups in China, they usually do a mix of all this. A mix of organic growth, some partnerships, some joint venture, and some controlling acquisition, either controlling or minority. And even they would do some VC deals through, you know, private equity funds, doing like CVC, you know, corporate venture capitalism. So by doing a mix of all this, it allows them, even, I'm not only talking about big groups, I'm talking about smaller companies as well. Because this, having like this multiple point of contacts with the market, you have multiple channels, because this market is so dynamic, it's so sometimes brutal. I mean, we saw that for COVID, but in general, we saw that the brutality of changes, the brutality of regulation in many, many aspects, and this is also for me, is very different from the rest of the world. You can not anticipate such brutality, but if you have all these captors, you know, if you have these like indicators from various points of contact of the market, from various people, whether it's your Chinese JV partner, whether it's the target you acquired, whether it's your partner, or whether it's your own team organic growth, it gives you feedback on the market. And then you have more latitude to decide which strategy to apply and where to accelerate and where to decelerate. So we believe it's a mix of that if you want the winning combination. It's not one or the other, it's like all of the above. I don't know if you want to say. Yeah, you will comment that in more details. No.
Yeah, so select your strategy. We wanted to share with you what we saw in the market during these last years. The first thing is we are observing some big players going and investing and increasing investments. So they double down. And these are, generally speaking, the best in class. They increase their investment in China. So I guess you have all heard about Volkswagen or BASF investing pretty large amounts of cash in China. Too big to fail. We cannot go out of China. We need China. So that may be one of the motivation of these large groups. We have clients also doing this. They are investing in China. They are seizing the opportunities. Again, these are the best in class. And I think that's interesting because I prefer to follow the best in class than the people who say, oh, China is complicated and they miss the strategy. These investments are done through new corporate vehicles, or they are buying their partners, generally speaking, Chinese partners, so that they can consolidate and increase their volume, or they are consolidating their figures in China. The second thing that we have seen is retro JV. I have seen that mostly in industries which are in difficulties, and here I think about the mass retail. I think about all these industries that have basically been here for 20 years, and we set up these companies 20 years ago. The big distribution, you know, Carrefour, Auchan, some of the mass, you know, fashion companies. They have WOFEs, and now they are somehow selling their assets on the Chinese market to Chinese players, and they keep a minority. They will keep, you know, a seat at the board to understand what's going on with China, but somehow they are doing a kind of exit. Three, we see some companies exiting, and that's interesting because the company that we have seen exiting are actually bought back by either Chinese players, but mostly in my case, I've seen foreign players buying in. So the number one increasing investment is actually the one buying these assets. So some smaller companies, they miss the strategy, they miss the digital curve, they are somehow, they cannot follow the pace of the market, they are exiting. Carve out of the Chinese operation. That's another very interesting scheme that we have seen. Some groups, they bought several targets in China. They are carving out all these targets. They put them into a holding. And in order to continue growing up and investing, they will raise funds from either foreign or Chinese PE. So they are raising money. And we've seen that in the service industry very recently. They are trying to do an IPO. We have seen that in the fragrance and the cosmetic industry, or they are finding local funds. So they continue to grow up, but they de-risk their investment by using local fund or local partners. And we see also some light asset deal, MNCs that have decided to change their way of doing business in China. For example, yes, you have all seen the Stellantis deal. Some companies, so you see there is a kind of mix. They are exiting the market, means that they are exiting their former, you know, old school JVs with sometimes SOEs, state-owned companies, and they come back in the market with light asset deal or investing minority shares in doing technology transfer, commercial arrangement with big players in the market. So basically my takeaway of that is, because I'm wondering what's going on this market, and I'm thinking, wow, if I read the press, somehow the market is crashing down. So should I be worried about that? And just to take an example, I'm checking the automotive industry, and we were talking about that a few minutes ago. If you check the automotive industry in general, it's not going so well. If you check the international JVs in China, it's a very complex market for them. But if you check the EV industry in China, it's a fast-growing market. So you need to select the best players on your market to continue to do business. If you are trying these days, I'm not an automotive expert, but very basically, if you're trying to do business with let's say, the international JVs or the people who are suffering the most, it may be very complex for you. if you are doing business with the EV industry, Geely, Tesla, BYD, because I take Tesla as a player in China in the EV car industry, you are doing probably the right, you are choosing the right strategy.
No, but you're right. You're right. It's true that you mentioned Carrefour earlier. It was in a way kicked out of China. I mean, if there's people from Carrefour, they wouldn't like me saying that. But imagine if Carrefour would have invested. I mean, it's always easy a posteriori to do the story. But if they would have invested in Alibaba, taken 20%, 15, 10%, 20 years ago, 21 Jack Ma went knocking at their door, it probably wouldn't be where they are today. And this is a little bit, you talk about Stellantis. That's what Stellantis is doing by taking 20% of Leapmotor in a way. So they have a foot in here, and they, in their agreement, they will be exclusive in representing the activity of Leapmotor outside of China. So this is very smart. They also control, it's both an offensive and a defensive deal. They control expansion outside of China. And just to conclude on that, the players you mentioned, because you're right, the press saying FDI is going down. Yeah, it's true. Foreign direct investment in China is going down, but you look, M&A is going up. So there is less investment from foreigners in China, but the foreigners are increasing. So less investment, true, but out of the investment, they do much more M&A deals, because we saw that inbound is increasing. And the players you mentioned, Stellantis, Volkswagen, BMW, BASF, they were here since like 40 years ago. Stellantis with Citroën, they arrived in 1984, I think. So no one knows better China than these groups. So if you see these groups investing now in China, it's very reassuring. So it's more the mid-sized company and the smaller companies who do less investment because they read the press and they don't see the reality. The big guys, they know it's a window of opportunity to invest in China, and they're doing it.
So factors to consider when doing an M&A operation in China. Impact of the regulation and administration. Of course, you need to understand the regulation first, because China is a very highly regulated environment, and every step of M&A transaction is under control of the authorities. Actually, every step of the corporate life of a company, even choosing your name, is still under control by the authorities, right? So this is also a very specific environment where some players, and I'm thinking about SOEs, will offer a less transparent environment. Internal rules of SOEs may conflict with your potential M&A strategy. There are some filings. So I would say that over the last 20 years, I have seen a large improvement when it's for filings and administrative operations. When you are doing a filing of an M&A transaction, let's say 20 years ago, it would take months to get your approval and then obtain your business license. It would delay the operation for months, maybe 2 or 3 months sometimes. However, these last days, when you file a deal, 1 week after the filing, you will get your business license. There's no more approval in principle. It's just a filing. Of course, if you are in a regulated environment, if you have to do some pre-closing filings such as antitrust or national security, which is somehow the anti-economic war mechanism of China, it will take time. But generally speaking, in mid-cap transaction, it's going super fast now. It's even really, really much better, I would say. Due diligence, another topic. It's still complex. There is a slow improvement in due diligence because there is still a lot of inexperience from the Chinese sellers in organizing data rooms, collecting the data. I would say the main problem is that the data sometimes doesn't even exist. So that's a problem. The financial due diligence is still very challenging for the financial auditors. I think that also something that is, there are new topics that we need to address, such as the cybersecurity, which is becoming a big topic in the compliance program. So all this makes the Chinese government a little bit risky, or let's say it makes we are evolving in a market where it's difficult to really assess the risks. So it will impact the way we do transaction and we structure the deal and the pricing. Another topic which is interesting is the absence of data on deals. If you are basically doing a transaction in US, you have a lot of data on how you will negotiate, any point of the deal. So, the percentage of, for example, what is the cap in this transaction, the cap of liability of a guarantee. You will have a lot of data on how people are negotiating, which creates the market practice. In China, this does not exist. So it also means that players or foreign players who want to enter this market needs to work with real specialists of the market in China, because we are actually aware of the market practice. And this market practice is absolutely cannot be found on databases otherwise.
Yeah, just to rebound on what you're saying, I mean, just an example like that, you're saying about the data, financial data, have they paid their social? There's always a discussion about social welfare, about tax, has it been paid or not? One way to circumvent the issue is you do what we call normalized, so you do a normalized EBITDA, normalized operating margin. And from this normalized aspect, whatever is unclear, you consider what would be this amount if you would be paying, the normal tax, normal welfare, and so on. And then the negotiation could be around this normalized metric. So that's the way you also, in terms of pricing, you would bring the pricing down, obviously. Just one idea to rebound what you say.
Sure. The way, and this impacts the way people are negotiating their transaction. Chinese sellers or buyers, they may ask very strange things for Western negotiators that are used to make transaction in very, let's say, regulated or markets where there is a large market practice. The deal, and we're talking about negotiators in China, of course, the cultural gap between the negotiators will request you to do a lot of cross-check questioning. So we will take more time in the negotiation to make sure that people have the same understanding. Translation may take time also. It will impact the timeline of a deal. So when we see people saying, oh, let's start this negotiation and let's close it within a month, not going to happen. Or maybe if it's happening, it may not be good for you, because you need the time to have, to make sure that parties have a clear agreement, and you need to question this agreement. You need to question the limit of your partners, again, because you are in a very specific environment where enforcing decision may be complicated, legally speaking.
Yeah, but just on the duration, and usually when we are on the sell side, when we sell European assets, now we are in 19 countries. So in any of the countries, what we tell them is if we are looking at a Chinese buyer, start ahead of the others, taking into account that it's longer. Selling to a Chinese buyer is always longer. So you need to integrate that in your process. Yeah.
There is still difficulties. There are still difficulties to secure transaction. When you are buying a company, you will negotiate what we call reps and warranties, which is let's say a guarantee that the seller will give to the buyer that any event, any negative impact before closing will remain or will be borne by the seller. It's still complicated again to have to negotiate and to obtain reliable guarantees. One very specific element in the cross-border transaction in China is that the liability guarantee is difficult to enforce when we are in a cross-border transaction, because of if you are asking your seller to pay you back a part of the money that he has received, due to the foreign exchange regulation, it will be complex for him to pay this money and to remit the cash out of China. So there are conflicting regulations that may actually negatively impact your guarantees. Also, it will be complex to use third parties as escrow agreements. So due to the Forex rules, it may actually push the parties to consider doing a transaction when it's possible with local subsidiaries, for example. It may impact the way you are structuring deals. It may impact the way we are negotiating the price. It may impact the way we are sequencing the transaction afterward. So common mistakes, the quality of the due diligence. We still see very amusing things where people will, they will do a large audit on empty shell in Hong Kong or in Singapore holdings, whereas the operations are in China. Confusion on the property. It's just somehow still amusing to see that people are still missing the point. The targets, land use rights, very basic due diligence mistakes that may have a very large negative impact on the transaction. Today, we see a lot of new issues with the data protection and the cybersecurity related regulations. I think that the second point also, underestimating regulations, ignoring the regulation can lead to delay and problems. We have, for example, seen many transactions where parties will refuse to do a notification on antitrust. And at the end, when they discover that they need to do it, they will lose several months to do this notification because it has to be done before closing. So anticipating the impact of the administrative formalities on your transaction may be very useful to define your business plan and the timeline of the transaction. 3, overestimating the impact of the partners' relations, the guanxi. Many foreigners still believe that there is a kind of magic around guanxi. They will believe that, or people may believe that with the right guanxi, everything is possible. I think that commercially speaking, it may be very useful. In the course of a transaction, we shall not overestimate that. We have seen many people saying, "Oh, we can obtain the license because my partner is a SOE." No, it's not true. The SOE cannot do everything. They sometimes even need to discuss with other administration and deal with a lot of other problems, internally speaking, or political problems. They cannot do everything. And of course, understanding the local culture or the local constraints. And here, I'm talking about the technological environment, because obviously you are in China and you're aware of this technological environment, the way things are done, but also the speed of a transaction and the reactivity of the Chinese counterparts, which means that you need to have the right level of decentralization with the headquarters to take decision locally, which means that you need to have a clear technological or technical audit in order to understand the technological constraint that applies to your transaction.
Just to rebound on that, I mean, earlier I was showing the successful European companies or foreign companies in China. They apply all of the above in terms of the structure of the deals, but in terms of management and decentralization, the successful companies are also the companies of whom the China head reports directly to the group chairman, because we know, the decision, the time of decision will be really, really fast in this country, and the idiosyncratic aspect, it's so I mean, specific being in China. So you need to have this direct in terms of access and channel to the chairman to take quick decision. If you don't do that, then you won't be able to take decision in time. Your success will be much, much harder. Okay, next. Yeah.
I think that one of the main, the first thing is the legal nature of the targets. We are in a country where you have two kinds of players, or three kinds of players: foreign companies and local domestic companies. Now, the regulation has uniformized the status. There is not so, they have the same treatment, except in some specific cases where you're talking about industries in the negative list. Okay, so in my case, I see a lot of deals related to telecom industry, which will trigger some specific ways to do transactions. Okay, but I would say that in principle, private companies and foreign invested companies are treated the same way. Same administration, same treatment. However, we are still also seeing a lot of transactions with state-owned companies, which have a very specific status. They will take decision in a very specific way. They will sometimes react on a more political, they will take decision on a more political side than business side, because they have a mandate from the state to operate. It's a different way to take decision, different rationale. And their assets are controlled by the SASAC, which is an organism, which is an entity, an administrative authority that will make sure that the right price applies to the state-owned assets. Secondly, so is the price that can you determine your price freely in China? Actually, there, according to the M&A rules, you need to have a prior assessment of the private assets that you are trying to purchase. Means that in theory, you still need to have a valuation report done in order to control the value of the assets that domestic companies will transfer to foreigners. In practice, there is a huge flexibility. However, if you are talking about assets of state-owned companies, there will be, of course, a huge control, less flexibility. And if you are, for example, trying to purchase state-owned assets at, let's say, 90% or lower than 90% of the valuation, the deal may be actually under scrutiny by the authorities and may be blocked. So another thing that is a bit specific to the way we are doing transaction in China is that as we are filing the documentation, the share purchase agreement, so we are filing the contract, we need to indicate a price in this contractual documentation. Whereas if you are doing a transaction in other jurisdiction, France, US, whatever, you may have a price based on a calculation or based on a calculation formula, no fixed price. In China, you will need to indicate a price, which may sometimes be a bit weird because you are not able to calculate the value of the company you're buying at the time where you're signing. The payment is also subject to regulation. There is a payment schedule imposed by the regulation. Again, there's a large flexibility for this, but it may actually impact the way we are doing the transaction, specifically for the earnout. So in China, it's true that we may purchase more, companies in tranches instead of purchasing 100% of the company and doing what we call an earnout, which is a price adjustment based on the future performance. So again, the main point is that the regulation impacts the way we are thinking and structuring transaction. Also, there are some specific, tax issues to take care. Most of the foreign companies purchasing assets through or indirectly, let's say you are a French company, you're buying a Hong Kong company, or you're buying a Luxembourg company with companies in China. This purchaser may have a potential indirect capital gain tax to take care of. And I'm talking about that because it may be a risk for the purchaser because the tax bureau in China may actually ask the purchaser to bear the liability of a tax that should be paid by the seller. So it may push you to structure your deal otherwise, or very specifically. Again, in China, you will have to take care of the impact of the foreign exchange regulation. We talked about that. And you will have to take care of all the filings and the administrative constraints. Just to summarize, just to give you an example, we are organizing the closing, which is so when you're doing a transaction, you have basically two main steps, which are the signing, so the day where you are somehow signing your transaction, and the day you are closing, which is the day where the payments and the transfer of ownership is happening. In China, because you're filing the documentation, you may be in a situation where your client, when you have filed the documentation, the authorities will not approve, but they will issue the business license with the name of the shareholder on it. And it may put your client in a situation where he has to pay the price at one point because it's quite hard to go backward. So what we are doing, we are structuring transaction with a pre-filing timing where we are checking that all the things that need to be done, condition precedents, are completed before filing. Whereas in most of the countries in Europe, you would basically sign and close on the basis of a documentation that will give you enough comfort to check that all the pre-sale restructuring have been completed. So to give you an example, if you need to obtain certain certificate before the closing, you will just get the certificate and prove to the buying party that you have obtained it, and then the party will pay. In China, you will organize the deal this way. The seller will obtain the certificate, show the buyer that he has obtained it, and then we will file the documentation that has been approved in advance. Again, I'm saying that it's a bit technical, sorry to bother you with that, but just to show you that this very specific Chinese regulation and Chinese government is pushing us to create different ways to deal with the transactions. And it's something you need to explain to your partners and also buyers.
But there are ways, I mean, on all these aspects, there are ways to go around, and I would say you have very specificities. I mean, you mentioned about the price, for example. You can, in pricing, there's two main mechanism. There's what we call the lockbox, so it's according to the last audited accounts, for example. So you would agree on the price on the lockbox basis on the day of the filing, so the price is fixed, taking into account there's not be any leakage. Or if you do a price, the second way to price, so you have the lockbox price is fixed according to audited account. The second mechanism is a price adjustment according to various metrics. I'm not going to go into details because those who are not technical is going to be boring for you. But then you will do this adjustment as on the filing. So you will look at what is, for example, the cash flow level, the various debt level on the filing date, not on the closing, as we call closing in Europe, not on the payment date, but on the filing date. So the price can be fixed when you file. So there is, for all these aspects, you can go around. Another way, guarantees is true, is very hard to enforce, but you can have a mechanism. For example, if it's really serious, the breach of guarantee is really serious, you can have put call options where you say, okay, if you will breach too much, then I'm forcing you to buy back the shares that I bought from you. So there is mechanism. We have to be creative, but for this aspect, being creative can be circumvented. And then at the end of the day, that's what we're here for, right? To bridge gaps between the two parties. I think, you have
so
two more.
I think that this one we already discussed about because it's mostly related to the way we are doing and we are dealing with some of the administrative control. To take an example, when we are talking about large transactions, you may have to file the deal to the authorities so that there is an antitrust control, and this antitrust control has to be done before closing. So we will have to somehow sign we will have to prepare the documentation, keep the documentation somehow on hold in escrow, do the filing for the antitrust, and then file with the authorities to obtain our business license at the end. So again, this the point is really to show you that the Chinese government is pushing us to create ways to do transaction differently that what people may be used in Europe or in US, and that's something that we need to explain. And again, sometimes it will create a lot of actually mistrust. It may create a lot of disruption in our negotiation because the foreign parties have difficulties to understand why we are acting this way, or why is it something to protect the Chinese party. So this will create a lot of let's say psychological constraints on the potential seller or buyers. To move forward, I think that on our ways to conclusion, the outlook, one of the outlook we have in mind is that when we have still a lot of JVs in operation, and I know that recently people were asking, "Oh, shall we do more JVs in China to de-risk or for strategic reason?" Emmanuel, you mentioned that a little bit at the beginning. What you have to be aware of is that if you are today operating a joint venture, there is a deadline, which is the end of 2024. At the end of 2024, the documentation and the shareholder agreement have to be renegotiated. Articles of association of JVs have to be renegotiated. So personally, I can anticipate a lot of negotiation in the current JVs or in the the existing JVs since actually 2020 and the new foreign investment regulation. The structure of JVs has changed. There is today a new this regulation since 2020 basically is saying that the highest authority is now the shareholder meeting. Before, the law was saying that the highest authority is the board of directors. So we can anticipate a lot of problems with JVs where the documentation has been poorly drafted. If for example, your documentation, original JV contract or articles of association were saying that we are not specifying the highest authority, we are not specifying anything related to shareholder meetings, I can anticipate many problems with, for example, your capacity to consolidate, your capacity to exercise your corporate governance and take decisions. Decision may be challenged, right? Because starting from 2024, the regulation may impose you to. So after 2024, if you are doing a transaction, the authorities may push you to update your documentation, and we start to have this request from the authorities, and you will have no time to renegotiate peacefully your documentation with your Chinese partners. So we may be in a situation where after 2024, authorities will push you to, again, stop your capital increase, for example, and ask you to update very quickly your documentation as it is a pure administrative thing. But in reality, you may be in a situation where you have to renegotiate the way you are taking decision with your partner. Just to give you a slight example, in the old JVs, the Chinese party has a veto right for some operations. This veto right has disappeared in the new regulation. There is a law of majority. So if you're holding 66% of your capital, the majority shareholder can take any decision. This may create disruption with your Chinese partner who believes that he still has this veto right, whereas he's losing it according to the new regulation. So we can foresee a lot of maybe negotiation which are actually pushed by the authorities to upgrade and update the existing JVs. So that's one thing that we have to take care of.
With the microphone, that's the last slide. So as a conclusion of what are the trends with we are seeing today. So I would say maturity. So you know, I mentioned a little bit about the craziness of 2016, the exuberance of these the deals that we saw, and the kind of irrationality in the past, what we see now from Chinese groups, and we talk to them almost on a daily basis. They care much more about strategic sense. You know, we don't talk about football clubs anymore. I mean, they could not anyway because the regulator has stopped that. But they look at, you know, synergies with what they do. Valuation matters, you know. So I think, and locally in China, investors and buyers of Chinese companies look at the profitability and no more market share. So I'm sure, you know, I'm 20 years in China, and my previous first 10 years I was in the heavy industry. And I'm sure we all share that. We all like, is China mature? I mean, we all have the feeling this country was not mature. So are we seeing the beginning of a maturity? We believe so in the M&A world. at least. Internationalization. So, we see, and by the way, on the inbound deals, when we did the Bell deal, the target wanted to become an international company. So by opening your capital and your shareholding to a very large foreign group, in a way, would help you to become international. And the best of both worlds is a little bit what I explained with the valuation. You buy, but you take credit for the growth. You take advantage of the growth, and you try to improve the EBITDA. I explained that earlier. Regulatory, you mentioned it. Everything is much easier. So in terms of acquiring companies in China, so overall should promote more internationalization of the groups. Blurring of frontiers, we see that in many, many areas. And I just gave an example, but it's true in many, many sectors where, for example, between healthcare groups, between beauty companies, between sport nutrition, for example, and food companies, everybody's trying to reach on the other segment. So it's kind of the more and more intersection between these activities, and this promotes, of course, M&A. Consolidation, acquisition, also blurring sometimes, between SOE, POEs. What we see on Chinese outbound deal and the discussion we have today is we see some private companies teaming up with state-owned companies, for example, local government financial vehicle, who are looking for some technologies, but they don't really know how to conduct deals. So they team up with private-owned groups to help them, in a way, act as an advisor for them. So we see that. We see more and more verticalization. So also this promotes acquisition. For example, in the automotive, you all know BYD. BYD, they make their own battery. That also helps them to be one of the only, with Tesla, profitable EV manufacturer in China. Most of the others are losing money. So we see all that. Strategic and financial is a bit what I mentioned also. We see strategic companies doing more VC with like what we call CVC, so corporate venture capitalism. So this corporation, they have an arm to invest through VC. So all this is like blurring of the lines, I would say, supports M&A trends. Scale, size matters. So of course, the Chinese economy is slowing down. We see that. For me, it's undergoing a crisis that doesn't say its name, but that's another topic. But when you see an economy slowing down and an economy which is very fragmented, as we mentioned, it triggers consolidation. This also supports M&A. We see a lot of consolidation. What we saw on the domestic deals, what I showed you earlier, domestic deals are down by 40%, and most of the deals are between SOE. So there is a lot of consolidation happening in China between SOEs. Of course, you can consolidate up to a certain extent, because then you trigger the antitrust, and then you need to divest. That's what we see for the Alibaba, Tencent, which are selling a lot of the investment they have done in the past since the regulator, hit them on the head. And then size also geographically. So we see, because we are quite strong in India, we're very strong in Vietnam, Singapore, and also Japan. We see a lot of foreign companies in China looking for China plus one. So, and it's true for foreign companies in China. It's also true for Chinese companies who want to, for example, export to the US or to Europe. They would look for base. This also supports M&A acquisition from these groups outside of China. This is something interesting. So it's a bit ugly on the graph, but I just put it this morning. So it's from the, you probably saw that, it's from the France Business Climate Survey, the Chamber of Commerce. It's just out. I think it has been sent to the members already. So it's between May this year and October. We ask the people intention. So it's French companies conducted by French Chamber. So we ask them, what is your intention between how many % you are wanting to create JV? This is the percentage. So it's going down everywhere. So people wanting to do more investment in China, you saw between May and October has been going down. But you see people wanting to do acquisition is stable, even increasing a little bit. So what it means is that, people would tend to invest less, but the proportion of M&A increased slightly. So the among the investments done by foreign company, French company in this case, M&A represents a larger size. So this supports what I was introducing earlier in terms of inbound. People see an opportunity, it's like buy the dip, like in trade. If those of you who trade shares, you buy the dip when it's down. It's probably the right time to invest in China by a company. That's what I say, opportunism, what I just explained, window of opportunity. And of course, geopolitics, it's probably, Bruno was telling me it has always been political. You are right, in China, but it's more on the geopolitics you know, we do some deals with foreign companies in China. They don't want to communicate. They say, I cannot communicate about my deals in China because it's too sensitive. You know, this is new. I mean, 5 years ago, 6 years ago, it was an asset to buy a company in China. Now people say we want to be discreet, no communication. Everything is politicized. And of course, I mean, you saw the Broadcom VMware deal was just, he was blocked. So it's between two American companies. They were expecting the antitrust from China. It was blocked until Joe Biden met with Xi Jinping last week, and then the deal was accepted by China, and now the two American companies can merge. So you can see, and you mentioned it as a weaponization of the antitrust. We can see that. So, and of course, decoupling, de-risking. So this also the de-risking aspect in both ways. By the way, the de-risking of European companies in China. I mean, President of the Commission is in Beijing today, meeting the president. It also could also mean more acquisition by European companies in China in a way to secure their supply chain and to be less dependent from supply chain outside of China. So all those is what we see in terms of trends supporting M&A. Bruno, if you want to rebound.
No, just interesting fact. I think that it's true that when we talk to PE funds, they will tell, oh, there is no more investment from US, or there is no more investment from Canada. And at the same time, we see new players, new trends such as Middle East, such as Mexico, Brazil, who want to make more business with China. So I think it's again, it's just what we see in the press, what we see in the world. The geopolitics are moving, and the question again for me is how to be in the right trends and how to, you know, work with the right player at that time.
Exactly. So thank you very much. I think we're done. We have some space for questions. Anthony, sorry, it was ladies first, but he was first to raise the hand.
You were talking about the regulation. What is the main goal of what's the benefit?
So I think that first of all, the JV law has there is a willingness to uniformize the system. So now there is no more JV law, and every company is subject to the company law. So that's the first trend. So the idea is that uniformization of the systems. And the main risk is, again, there is a timeline to update your JV contract and your documentation. There are super old JVs where the documentation, to be honest, was drafted in a very basic way, and it was more conceptual than very detailed mechanism. So it may not work actually under the new regime. Again, when I see this old JV contract where there is absolutely nothing specified on how the shareholder meeting is working, and there's only like a small paragraph on how the board of directors shall work, we may be in a situation where the corporate governance becomes super unclear. We may be in a situation where actually your capacity to consolidate is questionable, specifically in the case where you have a JV 50-50%, right? You have to define who has the power to control the company to consolidate. This may be actually challenged by this change of regulation.
You can hear me? Yeah. So inbound is from a Chinese perspective, right? So from Chinese perspective, is thing coming in. So it's foreigners buying in China. So foreigners, we're talking about M&A, so merger and acquisition. So foreign companies acquiring companies in China. That's inbound.
Cash coming from overseas.
Voilà, cash and operations. It's equity. So it's M&A. So it's companies acquiring other companies. All the figures, they don't treat with a foreign direct investment. You could hear FDI, because FDI is mainly three things. FDI is greenfield, a foreign company arriving in China has nothing, is doing his own factory, whichever, from scratch, organic growth. Second one is extension. So he's already in China and he's extending it. So he's adding capital, adding investment. This is still FDI. And the third channel is acquisition, M&A. So he's buying a Chinese company or a foreign company. He's buying an entity based in China because it's inbound, because it crossed the border. It's cash, equity, money coming inside China. And domestic, as the second one, domestic is the same, but between two entities in China, mainly two Chinese companies, but it can be two foreign companies based in China buying each other. So the money doesn't come out from outside; it stays inside. Most of the deals are between two Chinese companies in China called domestic, and most of it this year is between state-owned enterprise. Exactly. You're exactly that. They buy the dip, as we say, because it's crazy the way how the valuation went down. It's really crazy. I mean, I can show again. It's almost divided by two. Where is it? We have a slide showing that it went. Yeah, you see, but that was a crazy year. But it went from 16, so pre-COVID, to 8. You see, divide by 2. So it depends of the year. So this is the value of a company compared to its profitability. Let's make it simple. So yeah. So now it's growing. You're right.
The FDI not consider an acquisition if the fund is coming from a local loan.
Alors, if a local loan, whether foreign or whether Chinese, is buying a company in China, it will be a domestic. It will not be an FDI. If it's a foreign company, for example, your company, Saint-Gobain, they would have cash locally. They would acquire another company. It doesn't cross the border, except if some of the funding comes from UHQ in France or comes from another entity outside of China. Yeah. That's why, by the way, you probably saw that the FDI, the balance of payments was negative the last month. You probably saw something like that, because the reason why it was negative is because many foreign companies repatriated their earnings compared to last year. It was negative compared to last year in terms of evolution, because in the past, foreign companies in China were keeping their profits here and they were developing, buying companies or whatever, doing organic growth, using their money locally from their earnings. But this year, for the first time, it never happened since the history of this metric, that foreign companies repatriated outside of China more than what they did last year. So it became negative balance of payments. One of the reasons, a bit of de-risking, but the main reason that people have analyzed is more because of the spread, in terms of yield. So just to make it simple, cash is better invested because interest rates are higher outside of China than within China. So companies will send their earnings outside of China because the returns are higher than what they would be in China. Main reason for that. Wofi, I mean, as the expert, but you mean in this? So what is your question again?
So if
No,
you
Bruno,
are,
attends, sorry, just one thing. This includes deals from Hong Kong. Hong Kong is considered outbound in this, and including, by the way, FDI. Even in China metrics, it's what I'm saying is politically correct, because at the statistics level in China, if you have, mainland China, deals from Hong Kong are considered FDI in statistics.
No, the valuation is not really impacted by the structure of the shareholder. The valuation is impacted by a successful operation, by the level of operation. And why the valuation were going down? It's basically, just to give you a very simple example, during COVID year one, Chinese sellers were still saying, "Oh, this is exceptional, and I shall keep my valuation based on 2019." After 2 years or 3 years, you cannot say that anymore. Your activity is lower. You, as a seller, will basically have an impact on your valuation. So you can either sell at a lower price, wait for many years to reconstruct actually your EBITDA, which probably will discourage a lot of entrepreneurs. They prefer to sell now and get what they can.
Yeah, and you know, valuation is mainly so when we value a company, we do what we call a multi-criteria approach. So we look at mainly 3 criteria, put it simple. So we look at, you know, the cash flow that the company is going to develop next few years, and we actualize, but let's not go into detail, but we look at how much cash the company is going to generate. That's one methodology. We look at that, and we look at business plan. As Bruno said, if there is uncertainty in the economy, you know, your perspective of sale will be lower. So this would lower your valuation because you have less cash flow in the future. That's one aspect. Second aspect, you look at the stock exchange. So you look at comparable listed company, and the stock exchange is last time I checked, I think China is -6%. So where the rest of the world is increasing, you know, I think S&P 500 is around plus 17, 20% this year. You know, CAC 40 is probably around the same, 15, I think last time I checked. So, you know, the Chinese stock exchange is negative. So you look, so that means the valuation of Chinese listed company are going down. So we look at that, even though if you do a deal between 2 private companies, even though the companies are not listed, you look at comparable listed company. And Chinese listed company has been going down a lot. And then the third metric you look to have your valuation, and you do a combination of all that. You know, it's not science, it's art valuation. You know, at the end of the day, you know, what's make the valuation is the market, really. Is the market. You know, you can do all the calculation you want. But the third metric, just to finish on that, is you look at what are the recent transactions in the same space. Other companies, and we have database for that and so on. We follow a lot of information on that and articles and so on. And we look similar transactions, similar players, similar size, how much were they value? And we look at all that and we have a valuation. So you see, it's going for all this reason I mentioned, valuation are down a lot. That's why foreign companies are buying much more than before. One of the reasons. We see Bordeaux merger. For me, one of the best database, and you know, this database, they are tracking every deal daily basis, hour by hour. I get the deal live, you know, all the time. So yeah, no, yeah. After we are less exposed. I mean, in our firm, we see a lot of appetite, frankly. We are less exposed to the US, even though CFI, we're quite big in the US, but in terms of inbound, you're right. We don't see much US companies in our firm. But if you look at the statistics, we did not work on this deal, but Bain, in the top 5 deals, the first 9 months, Bain Capital did a big operation in software, a few $1 billion. They're in the top 5, Bain Capital. Check it out. So they are on the statistics. And then, it's still not a lot. We're talking about 50 billion. I think in France, the inbound in France per year is between 60 to 80 billion. Can you imagine a country like France, 20 times smaller than China? So for me, this is an anomaly. China should have much more inbound deals. We're talking about, the best year was what, 55, less than 60 or maybe 59. Yeah, 60 billion. Yeah, maybe 60 billion. That was the best year. This is equivalent to a low range in France. I mean, you have to put things in perspective. Inbound in the US is probably 350 to 400 billion dollars. I mean, so for me, it's an anomaly. First thing, it's nothing inbound here, frankly, it's a joke. Second thing is, one of the biggest deal, so the first 9 months, is the El Caterton SPAC from Singapore. They acquired, so it's, I think, 5 billion. So you see a few deals can, change the needle, push the needle, can balance, So El Caterton SPAC in Singapore, they acquired, the Lotus electrical vehicle from Geely. So, you need a few deals at 5 billion and that's it, you're there. Huh? And then another big deal. So I'm going to give you the top 5 deals, okay? Another one is the Saudi Arabia. Saudi Arabia, they invested in petrochemical deal. Again, few billions. You have Renault, the French car maker. French, El Caterton is half French, and Renault, both in automotive. So French have been very active. They, with Geely, they did a joint venture on all the engine, ICE engines. And this is also valued in China because they're going to do some transfer of assets and so on. So, and this is, I think, 3 to 4 billion. So it goes very quickly when you have such a small amount. Frankly, we see appetite. Big groups, what I was saying earlier, people who know very well China. And I think French groups, and geopolitics is important, and between Europe, and we're going to see what's happening today between those people from Europe and the president, but relationships are quite good. So European companies are still quite active. Yeah, we see from mid-sized companies to bigger companies, we see appetite on inbound. Yes.
And again, we see new players.
Yeah.
That's just to give you, an example. I was in IBA in Paris, 6,000 lawyers meeting in Paris from everywhere in the world, everywhere. And when I was mentioning that we are a law firm in China to North America, Canadian or Australia, they were not so interested to discuss for various reasons. But the first reason was, we don't have any transaction with China these days, period. However, when I was talking to, I have received a lot of invitation from other countries, new players, BRICS basically. And it was very interesting to have a concrete experience of what you see in the press and what you hear. It's like Mexican lawyers, Brazilian lawyers, really like saying we have a lot of transaction with China. We need support. So I think that for me, it's like there will be new trends. We are not living. I think we can be impacted by geopolitics if we are in microchip, if we are in genome studies, if we are in very specific industries that are basically under scrutiny. However, all of us, if we are not in these industries, we just need to choose the right players and make business, and that's it. Jean-Marie. Questions, comments, insults?
Are they some newcomers among the companies? So, the other thought is about the trust. And it considers all the companies are only serving revenue or because our tax or to the M&A part of the M&A is a growing part of the NDI, one part together with the field. But it's still a growing part of the because you see when the NDI is going down, when the M&A is going up, so the share of M&A and NDI is going up. So the people who invest are doing more and more. Secondly, it's true that it's very complicated. So it's true that it's long, much less players and mentioned and deal with currency discussing different companies. They are all already in China. So they are either already in China, for most of them, that's correct amount. Then you have, for example, the deal between for Belarus. They were already in China, but not that successful, I would say. So they needed, some acceleration. Yes, so these two deals from ways that we see for the company in China who are so in terms of success and they want to accelerate. Therefore, they want to deal. Now, human newcomers, there's a few, we know the system, but it's true, it's still a very, very small chunk. Most of the people are already here. And in some of the people mentioned it, it's like go left, then they're coming back.
Oh, right, I don't. And then they're coming back through another way. And also what we mentioned, the exit of some companies like we sold FM Logistic is doing reinforcement of Seva, but Seva was already here. So to cut a long story short, is more reinforcement of people already here. But as I was saying earlier, is people who really know China. For me, I would prefer to see that than the opposite. If I would see those big guys who have been in China for a long time leaving China, this is where I would get worried. But it's the opposite. The big guys are reinforcing themselves in China. So for me, this is encouraging. And the new guys are not really coming, but they read too much press. They should come more often here.
To come back to your question, the antitrust filing has to be done if the parties are exceeding a certain threshold of turnover. And actually, the recent what we can see is that there are drafts to double the thresholds. So actually, it means that China wants to release a little bit the pressure on antitrust, obviously. But it's true that the authorities may always control. They may always decide to control a specific deal. And I know that there is a big interest in industry specialists that give advice to foreign companies. You should take care of that, Jean-Marie. Just kidding.
And your question, I think, is adapted both ways for inbound and for outbound, for foreigners buying companies in China and also for Chinese companies buying companies in Europe. I think your question is valid for both. Usually in the deals we see, it's sine qua non. It's a sine qua non condition to sine qua non. Otherwise, you don't do the deal. It's a condition to the deal. Voilà. Yeah, and the fact not to preserve the CEO. I was rebounding to keep the team, to keep the existing team. I mean, except if the team is horrible, but usually if you buy a company, it's because the company performs well and the company because they're good management. So most of the time, there are some exceptions, people buying assets and so on, but buying a company, so the equity, a share deal, as we say. You don't buy an asset, you buy a company with the people inside. Usually you would want the management to stay. And we can be very creative. I give you an example on one of the deals we closed is people were triggering a kind of package for the management. So it was an envelope which was from the seller, because the seller was saying to the buyer, and he was saying to the buyer, I guarantee you that the management will stay, the sixth manager, because the buyer wanted to make sure the manager was staying. So we have an envelope of cash, which was paid by the seller outside of China to the management if they were saying to make sure they would stay. You know, these kind of bonuses. So most of the time, yes, it's conditioned and there are mechanisms to make sure the team is staying. And even the seller is so eager to sell, he wants to make sure the buyer is happy. So the management, even though he doesn't manage them anymore, he wants to give them part of the bonus. So that's on the management. Is the same when Chinese companies buy companies in Europe. They want to make sure, for example, when the founder is also the manager, they want the founder to keep shares. That's also what we see in China. So the best way, if it's the same person, if it's not possible, but in very often, the founder, which is the CEO or whichever management position, will remain in the company with some shares. And then there is a path after X amount of years, you can buy him out and purchase his share. So that's how you make sure the management will stay if they have some shares. So that's some idea, some mechanism, but it's usually part of the deal, yes, to make sure management stays there.
And there is an audit of the cultural fit, to come back to your question. So depends of the industry. It can be industry expert. It can be also HR companies doing the audit of doing a part of the social audit. It's part of the social audit. When you will purchase a company, you will check the compliance in terms of employment law. You will check the compliance in terms of also tax, social charges. You will check the population, the aging of the population, the structure of the population. You will check the interaction. Are they able to? Is there a part of the team that can communicate easily with foreign companies? How is the structure? So yeah, there is clearly a clear audit of the team, and then sometimes there is a more specific audit on key employees.
And during all deals, there's what we call management presentation. So doing the due diligence made by the buyer in China, but it's true everywhere else in the world. They do management presentation where they meet the top managers, top 5, top 6, whichever. They meet them, and then for 1 day, sometimes 2 days, 3 days, and each manager would present and they have direct interaction. So usually it's done. The local team, if the buyer has a local team, so the local team of the buyer will attend this management presentation from the management team of the seller. Yeah. This is key. There is no deal without management presentation, without meeting the management. It does not exist.
And also, it's going to structure the price of the sale. So most of the time, the founder will remain in the company. He will still manage or have a great importance in the management of the company, and he will receive his payment in tranches over the years. And actually, what we see in China, it's like a longer period of transition, up to 5 years. Sometimes I have seen that purchaser asking founders to remain in position for something like up to 5 years, which is for me very interesting, because if someone wants to sell the company, most of the time it's to exit or do something else, or of course there are other trigger events to sell your company, but most of the time you want to exit. So
it's also part of a guarantee, keeping the seller, the shareholder as a shareholder is part of the guarantee. If you see something not compliant, you never pay him his 10% remaining. So you keep him on board to act as a guarantee, because for all the reasons Bruno mentioned, it's very hard to trigger guarantee, to enforce guarantees.
Yeah.
Yeah. No. Yeah. Well, I think is a bit simplistic, to think that you're going to improve your EBITDA by firing everybody, you know. You know, if you're, I don't know, you're scary, you know. I know some American private equity fund, they have this reputation, and you know that very well. But usually that's not why people do M&A. I mean, you know, we are all managers here. We know how to run a company. You need to keep the performance. So, I mean, you may have sending from HQ at some position. I mean, finance, usually when you buy a company here, you want the CFO to be your own. This is things that we see. Okay, so that could be an extra cost on that, but then you could like get rid of the CFO. This is some things that can see, but in terms of the operational team, usually you want to keep them. But then how to improve the EBITDA? There are many ways. I mean, and I think you know this better than me, but I mean, what I did in my previous life in industry, you know, you bring the team, you acquire a company because we did some investment in China, we acquire some companies, you bring that team for training in your HQ, you know, things that can help. But you do some, you know, like commercial training. You do, if you are technical industrial, you bring them to your factory. You send some of your technical team. I used to run factories and I did joint venture in China. You send teams from Europe. You put some metrics, some KPI, and you know, you put some benchmarking and you benchmark the activity of your Chinese factories with factories around the world, you know, and you put motivation and so on. So it's not so much firing the management. In some case, you may have no other choices, but it's more improving and helping them to perform better by comparing them, helping them, training them, and so on. This is that's what we see in reality, by the way. Huh?
And what you're saying is also interesting because a part of the negotiation is to discuss about synergies. What and how will we make synergies and what the buyer will bring to the company. And another topic is how do we impact that in the earnout? So if there is if there are huge synergies, of course the price may like significantly increase. Shall I pay this increase or not? So it will be a discussion also on how do you cap or do you cap and how do you cap the earnout, because you are actually bringing a lot of synergies to the target co.
So I think it's the conclusion, but as you can see, for me, the possibilities and to address everything are infinite, really. You know, making deals since 20 years in China, we see it's infinite. And, you know, and Chinese people, I think they like it. They like creativity. So, you know, be creative, use the right people, be well advised, but don't hesitate to be creative. Both parties like it. And I would even say, if you're not creative, you won't be able to do deals in China.
You said everything.
At table. Can you share some wine and research or we can continue the discussion during the networking?
Thank you.
We started later. We started later.